Good evening and welcome to the Weekend Investing Daily Bytes. Today is 3rd of May and we are sitting in India around 4:30 p.m. and at 11:30 p.m. India Standard Time the Fed minutes will be out and we will know what is the change in the Fed funds rate, the interest rates in the United States, and how that impacts the rest of the world. Now, it is intuitive to think that Fed rates will top out and Fed rates will start coming down, and hence, overall global interest rates should start to come down, and hence stock markets will go up. That while that is a very nice self-reassuring story to have, I'll show you some very contrasting data today. So tighten your seat belts and look ahead for this data in the second part of the video. Let's come back to today. So, despite a good fall in the US markets on concerns of another bank failure, uh, and most other banks that have not yet been declared failed are already down 50, 60, 70% because many of them are actually insolvent. They are holding assets which are, if you mark to market those assets, then their assets are much, much less than what their liabilities are. And they are losing the bank deposits on a daily basis. So there is a crisis of sorts in the US. Remarkably, it has been a very smooth sailing so far, that this crisis has been handled quite well by the Fed and the US government in terms of offering unlimited liquidity, unlimited guarantee of $17 trillion of deposits, although there is only $100 billion in the FDIC book. Nevertheless, Nifty came out of this bottom end of March, went up till middle of April, had a nice 4 or 5 day correction here, and has had a nice 6 day run post that. And today we were, despite the US markets coming off, just about maybe like sideways movement on the Nifty, still not willing to let go of this upward trend that we have, regardless of where the rest of the world is going. Nifty heat map is very, very mixed, I would say, but very marginally on the red and marginally on the green. So Hindlever plus 1.5%, ITC 0.75% up, Tata Consumer of 0.5%. You had Maruti at 0.4%, but then a lot of minus 0.5%, minus 1%, steel, cement, IT, everything kind of just taking off some of the profits before this important night where the Fed fund rate for the current season will be announced. And depending upon what is the ongoing statements by the Fed chief, whether they will remain on course for more hikes, or are they going to declare that this is the top, we are not going to go further hikes. And if that is the case, then at least for foreseeable future, that there is no hike coming. Lawmakers in the US have urged the Fed before this meeting tonight that please don't raise this interest rate anymore. Already things are about to fall apart, and the measurement of on ground reality is coming with a lag. So what you are seeing today is a lag effect of what you did in the past. So what you will do today in terms of interest rate hike, that will come with a lag over next 2 to 4 months or 6 months, and the recession will henceforth be in a lagged fashion. So you must stop right now and not go any further. That is the demand from lawmakers in the US. FMCG, real estate, public sector enterprise, and consumption were the only few sectors that remained in the green. Most others were down, including PSU banks, metals, and IT, down 1% each. So very, very, cautious stand today taken by the market, and also coming on the back of 6 days of continuous gain. So last 1 week is all green for all sectors. Last 1 month is also all green except IT. So can't be complaining about this kind of setup. Mid caps, very, very strong setup from 29,200 to 32,200. So almost a 10% gain here. And today also it has closed at a new recent high. So it was able to cross yesterday's high as well as close above that. That is also a positive reassuring sign. Small caps are also, gradually moving towards this trend line resistance that we had here. Very nice gain from here. Just one day of a sort of a larger fall, but very, very smooth up. So money seems to be flowing towards mid and small cap stocks. Nifty Bank, as I've been saying, again, looking strong. Nice green candle here. No signs of any concern or any fear about the Fed funds rate. This is very interesting now. This is the 10-year India government yield. This in June 2022 had reached its peak at around 7.6%. And since then it was in this sort of a channel pattern, contracting pattern, and then it has broken down here, and today it has come to a nearly a 1-year low, or actually it is a 1-year low, and it sits at 7.01%. So I think this is very good news for homeowners, for real estate stocks, for auto stocks, for equity markets in general, that Indian government 10-year bond yield is down to nearly 7%, and it looks going down further south. So as the cost of money keeps reducing, you will see more and more credit offtake, you will see more and more people buying real estate, you will see more and more people buying cars and other consumer items. So a fall in interest rates is always welcome. Now, the elephant in the room is the Fed rate, and let's take a look at some historical charts here. Now, this chart on the bottom, on the yellow line, the orange line is the Fed funds rate. So this is like the effective interest rate in the US, you may say. And we'll take the case from 2000 onwards, last 20 odd years. So last 20 odd years, the Fed rate went to a high of 6.5% in 2000. Then it crashed to 1%. Then it was raised to 5%, 5.25%. Then it crashed to 0.25%. Stayed there for good 7 years. Then it was raised to 2.5%. Then again crashed to near zero. And from zero, we have raised it now to 4.83, which is the fastest hike in the last many decades. You can see the angle of the raising of the interest rates, and this has been the steepest climb. Now, this blue line is the gold price in INR terms, and what I want to show you is the correlation of Indian gold price, Indian equity prices, and Indian bond yields with respect to the Fed fund rate change. So we will concentrate on these 3 periods. This period going from 6% to 1, this period going from 5.25 to 0.25%, this period going from 2.5 to this, and potentially now this is the top, and we will go down again from here in some future months. And we want to study what happens to Nifty when this falls, what happens to Indian 10-year yields when this falls, right? So the chart, the calculated chart will come at the end, but empirically and evidently you can see here, as the interest rates fell, gold price went up a little bit here. Interest rates fell here, gold price went up nicely here. Interest rates fell here, gold price went up nicely here. And if we fall here, you can expect maybe a gold price rise there. Now let's see what about Nifty. Nifty in this period, 2001 to 3, you know what happened to Nifty? We were down and out. 2008 to 2009 period, we were down and out. 2019 to COVID period, we were down and out. And what happens if the interest rates again start to come down? If the last three occasions are of any consequence, we will be down and out. So थोड़ा दिल थाम के ये data को समझिए, because this data is pointing to something that nobody is talking about. And I hope I am wrong on this. I'm not hoping that the market will crash, but I hope I'm wrong on this. But the data is there in front of you. Now let's also see the interest rate movement. So Fed funds rate here is on the top at going from 6.5 to 1, and in India interest rates went from 12 to 5. Then Fed funds rate went from 5 to 0.25%. India went from, first it increased from 8 to 9, and then from 9 to 5.5. In this fall, it went from 8 to 6, and we are now at around 7.3, actually 7.01 now. And if this falls back to 1%, we may go back to 6 or 5.5, something like that. This is what it is in terms of how India behaves when Fed funds rate top out till the time that they bottom. So October 2000 to June 2003, Fed funds rates went from 6.5% to 1%. Nifty went down 37%. Gold INR went up 42%. June 2007 to December 2008, Fed funds rate goes down from 5.2% to 0.15%. Nifty is down 58%. Gold is up 59%. July 2019 to March 2020, Fed funds rates crashed from 2.4 to 0.05%. Nifty is down 38%. Gold is up 48%. Sorry for the double percentage here. So it is very evident that whenever in the last 2 decades, Fed funds rates have topped out and started to fall, it has not benefited Indian equity. It has benefited gold in Indian rupees. Now, what will happen the next time, and what is being said is that today's meet is likely to be announced as the topping of this cycle's Fed fund rate. So Mr. Powell may announce that we are hiking 0.25% today, but there will likely not be any further hikes. And 2 months later, he may say that, okay, I'm now cutting 0.25%, or I'm now going to be cutting down 0.5% over the next 6 months. So that top is very near. If it is not today, maybe in the next month or next 2 months. But if after the next 2 months, whenever that Fed funds rate is getting cut for the next many years, if the past is of any precedence, then we are in for some long winter. I hate to present this data to you, but this is what the data is saying, and I am hoping with hoping against hope that this does not take place this time. And so very important that you asset allocate. Very important that you stay invested also in equities, because past data may not always predict what is going to come. So you must remain allocated, but must have insurance, must have a setup where in case this does happen for the 4th time, you have something that can balance the book for you. So this is all I have for this session. I think there are great takeaways from this data, and you must relook at this data on your own end also. Maybe I have made some mistake, and this is not this way. If somebody can point out the mistake to me, I'll be most happy. But this is a revelation to me also. I knew that post Fed funds rate topping out, the US recession takes a few quarters, but I did not realize that there was such a strong negative correlation with Nifty post doing that. So this is something for deeper studies for me also, and I hope that you will take cognizance of this impact. And let's see what happens in tonight's Fed Fund meet. So all the best. Thank you so much. Goodbye.